All right, today we're diving into the Q3 2025 earnings call from Mondelez International. You know them, they're the snack giant behind Oreo and Cadbury. And wow, the market had a big reaction to this one. So let's get right into the numbers and figure out what drove the stock's massive move. And yeah, that reaction, it was not a good one. The stock tanked, dropping nearly 6% in after-hours trading right after the numbers hit the wire. Now, that sets a pretty cautious tone, and it tells you right away that investors were looking at something way beyond just the headline numbers. Okay, let's start with those headline numbers, and this is where it gets interesting, because on the surface, the quarter actually looked pretty solid. So why the big drop? Let's dig in. So check this out. Mondelez actually delivered a slight beat. Their adjusted earnings per share, or EPS, came in at 73 cents. That's a couple of cents better than what analysts were looking for. And revenue, $9.74 billion. Basically right on the money with expectations. But here's the kicker. That organic growth of 3.4%, it was almost all driven by jacking up prices, which were up about 8%. That's a really important piece of the puzzle. And this right here, this is the whole story in a nutshell. You've got the good. They beat on revenue and they're still doing well in places like Latin America and Asia. But that good news was just completely swamped by the bad. Their operating margin got squeezed all the way down to 7.6%. And even more critical, their volume/mix, which is just a fancy way of saying how much stuff people are actually buying, well, that fell off a cliff, down 4.6%. The bottom line? People are buying fewer Oreos and Cadbury bars. It's as simple as that. And, that weakness in volume, well, that feeds directly into the real reason the stock got hammered. Management cut their forecast for the rest of the year. The outlook just got a whole lot cloudier. Yup, this was the key takeaway from the whole call. Forget the Q3 numbers, they were basically ancient history as soon as they came out. All eyes immediately snapped to the future. Management was pretty clear. The pressures they're facing from sky-high cocoa costs and, consumers getting tired of high prices, it's all proving to be a lot tougher than they thought it would be. And here's what that guidance cut actually looks like. So the old guidance for the full year was for about 5% organic growth and a 10% drop in earnings. Okay, now the new guidance, they're trimming organic growth down to about 4%. But the real gut punch was to the bottom line. They now see earnings falling about 15% for the year. That is a massive revision, especially when you're this late in the game. That's what really spooked the market. So the big question is, why? Why the sudden change of heart? Let's get behind the numbers and into the Q&A session with analysts, because that's where the real story started to come out. And this was really the only question that mattered on the call. What on earth is driving the weakness in volume and margins? And the answer, it turns out, is concentrated in two huge, really important markets, Europe and right here in North America. Okay, let's start with Europe. The story here is all about chocolate and the insane cost of cocoa. To deal with that, Mondelez had to push through some frankly unprecedented price hikes. We're talking around 30%. And the result? Well, shoppers push back and they push back hard. Their price elasticity, which we'll talk about in a sec, nearly doubled. On top of that, competitors, especially in places like the UK and Germany, didn't raise prices quite as much, which made Mondelez products look even more expensive on the shelf. Oh, and a July heatwave didn't help either. So what's the plan? They've got to adjust prices, change up the product sizes, and spend a lot more on marketing to win people back. Now, over in North America, it's a very similar story. Consumers are just plain tired of high prices. It's not just Mondelez. The entire snack category saw volumes fall by 4%. Management was super direct about it, saying the U.S. consumer is, quote, frustrated with pricing and is out there hunting for deals. And what does that mean? It means people are shifting where they shop. They're moving away from their traditional grocery stores and going to club stores and online to find better value. So Mondelez's plan is to follow them there, expanding into those value channels while also pushing their premium brands like Tate's and their healthier options, which are actually still doing okay. So I mentioned that term price elasticity a couple of times. Let's just quickly break down what that means, because it's absolutely crucial to understanding this story. All it means is how much demand changes when the price changes. So an elasticity of zero point 0.8 means that for every 10% they jack up the price, demand falls by 8%. Now here's the key. Historically, for them, it was only about a 4 or 5% drop. The fact that it's now almost double that, that is the core reason their sales volumes are getting crushed. All right, so with all that as a backdrop, let's get to our take. What does this all mean for the stock going forward? We'll look at how it's been performing and give you our official rating right here on the next call. And this chart, wow, this really puts things into perspective. Over the last year, Mondelez stock has gotten hammered, down almost 15%. Now compare that to the broader consumer staples sector, all its peers, which is basically flat. So this isn't just a tough market. Mondelez has been a massive underperformer. Okay, so this is the recovery story that management is now pitching to investors. They're basically saying, listen, Q3, that was peak pain. That's when the high cocoa costs hit us the hardest. The focus for Q4 is just to execute well through the holidays and try to get volumes back on track. Then, by the first half of 2026, they expect those cocoa costs to finally start coming down, which will help their earnings. And the big payoff? They're targeting a return to high single-digit earnings growth for the full year 2026. That's the light at the end of the tunnel they're pointing to. So where do we land on all this? Our rating on the stock is market perform. Look, the recovery story for 2026, it's plausible, it makes sense, especially if cocoa prices cooperate and keep falling. But, and this is a big but, there are some major risks in the short term. Management really has to prove they can stop the bleeding and stabilize volumes in Europe and North America. Until we see proof of that, we just can't get more positive. The path is there, but it's far from a sure thing. All right, now for our outrageous but plausible trade idea. Let's say you're listening to this and you're thinking, you know what? I actually believe in that 2026 recovery story, but I don't want to deal with all the messiness over the next few quarters. Well, one way you could play that is with long-dated call options, specifically LEAPs, that expire way out in January 2027. What this does is it lets you make a bullish bet on that long-term recovery, but with a fixed amount of risk. It's basically a leveraged wager that by 2027, cocoa costs are back to normal, people are buying more Oreos again, and the company's margins are looking much, much healthier. And of course, please remember, this is not financial advice.